global economy runs on one simple truth. Every product you touch started as a commodity. Your phone, your food, even the money in your bank. All of it begins with physical resources. How do raw materials go from deep underground to factories, to global markets, to your investment portfolio? Today, we'll break down the entire commodity life cycle, from the mine to the ship to the exchange, and finally to the investor. Let's dive in. Production. Every commodity has a birthplace. Every commodity begins long before it becomes a number on a screen, before it trades on an exchange, before it fuels an economy. It begins with extraction, the moment raw nature transforms into usable value. Extraction. Some resources are carved from deep beneath the earth. Metals are blasted from mountains and pulled from open-pit mines. Oil and gas are drilled from geological layers millions of years old. And agricultural commodities, they grow under sun, rain, and soil, long before a farmer ever touches them. Every commodity is physical before it is financial. Cost structure. To bring a raw resource to market, two cost pillars dominate the entire system. CapEx. The cost of building the mine, drilling the well, or buying the machines. OpEx. Cost of labor, fuel, maintenance, and transport. When CapEx and OpEx rise, prices usually rise with them. When production expands too quickly, oversupply drives prices down. Global concentration. Most commodities come from only a handful of countries. Copper from Chile and Peru. Oil from the Middle East and the United States. Rare earths from China. Cobalt from the Democratic Republic of Congo. Wheat from the United States, Russia, and the European Union. When production is concentrated, supply risk rises, and prices become more volatile. Soft commodities. Food behaves differently. Grains, sugar, coffee, livestock, they all face perishability, storage limits, unpredictable weather, and seasonal cycles. Agricultural markets are more chaotic, more emotional, and more sensitive to shocks than metals or energy. A commodity is born, but it hasn't moved yet, and until it moves, it has no value. Logistics. Moving a resource from point A to point B is often harder than extracting it. Commodities travel across continents using four main systems. Transport modes. Ships, tankers for liquids, bulk carriers for grains and ore. Railroads, built for volume. Pipelines, the lifelines of oil, gas, and chemicals. And trucks, the flexible final step. This movement never stops, 24 hours a day, across oceans, borders, and time zones. Global choke points. The entire world depends on a few narrow passages. The Suez Canal, the Panama Canal, the Strait of Hormuz. When any of them are blocked, global prices react instantly. Storage, the silent regulator. Commodities don't move from producer to consumer instantly. They stack up in warehouses, silos, tank farms, and LNG terminals. And inventory sends a message. Low inventory means tight supply. Prices rise. High inventory means oversupply. Prices fall. Logistics isn't just transportation. It is the backbone of price stability. Pricing. Commodity prices are discovered on major exchanges. Oil through Brent and WTI. Copper through the London Metal Exchange. Gold and silver through COMEX. Wheat and corn through the CBOT. These benchmarks set the reference point for global trade. Spot versus forward. Spot prices reflect the cost to buy or sell right now. Forward prices reflect what the market expects tomorrow. Commodity prices respond to everything: supply and demand, geopolitics, currency strength, inflation, weather patterns, seasonal cycles, and expectations of the future.